why build fast without breaking things? You know, the mantra is always build fast, break things. Some things probably shouldn't be broken early stage, right? I kind of sat on both sides of the table. As a founder, I built a company over the last 4 years, scaled that across 4 countries, and then had kind of the end-to-end company building experience of being able to exit that company, sell it to fintech in Colombia, and then open up space for new opportunity, which is the venture studio. So I understand very much the headspace and the emotional landscape of that pre-raise moment, right? It's a lot of ups and downs, it's a lot of uncertainty, it takes a tremendous amount of bravery. And so we brought together this group of people thinking about what's the most value we could create for founders that are in that pre-raise moment. And so in thinking about that, we thought diverse perspectives. The perspectives we bring to the space right now are finance, thinking about banking partners, how you get everything buttoned up on the financial front and get ready for a safe and productive raise, and then also legal support. And so it's going to be a fun conversation. We're very fortunate to have Lakeisha, GP at Emmeline Ventures, as our moderator. What I absolutely love and adore about her work is the fact that she is a mission-driven entrepreneur and investor. Venture capital to me is one of the most exciting asset classes on the planet because it's basically putting money, resources, and talent behind a vision of the future that doesn't yet exist, right? And what I absolutely love about your work is that drive for positive social impact. She supports a lot of women-led companies, and I find that oftentimes in venture capital, there's not a clear impact thesis. So way to go, knowing the impact in the world that you want to create. It's very inspiring to do it at scale. And she's going to be moderating the event, so I'm going to hand it over to her.
What a great way to set us up for our conversation today. I'm really looking forward to it. Hi, everyone. Welcome. So we'll just kick off really with intros, right? I think it'll be really great to really get the room, give them a clear understanding of who's leading the conversation today. So let's kick it off with you.
Okay.
Yeah.
Awesome. Hey, everybody. I'm Michael. Still. So I'm the founder of Build Momentum Venture Studio. We launched back in September. We support early stage founders. Typically folks that I would consider to be kind of industry experts, people really close to a specific problem. We're industry agnostic, and we like to give founders an unfair advantage. We help them with everything from early product development, finding product market fit, go-to-market support, and then also product acceleration. So oftentimes we'll partner with a founder that's vibe coded a product, gotten it to about 80%, it's almost prime time ready, and we'll throw engineers into it to get it ready for prime time, for example. We also do a lot of coaching and mentorship. And then also I run an organization called Queer Tech. So I connect LGBTQ founders, investors, and builders in LA. And it's been an incredible, kind of an open social club. And it's created quite the movement in Los Angeles. So thanks so much for coming.
So glad you're here. Love what you're doing, Michael, in particular, that this exists in LA, I think is huge and hugely helpful. Okay, over to you.
Hi, I'm Mark Lindquist. I am with JP Morgan Startup Banking. Startup Banking is still relatively new in a 250-year-old plus company. We were formed in July of 23 after much of the last banking crisis that happened that year. Yes, I work with a lot of SVB people and FRB people, which is great and really appreciate that. I have been with the company since 2008. I moved to Los Angeles in 2011. And my job is to provide you inexpensive banking services while you're scaling and growing your company. So we work with pre-seed, actually before that, bootstrap, pre-seed, seed, and we stay with you up to a Series A of 7 million plus. And once you raise 7 million plus, then you head off to our innovation economy growth team and you sit with an industry specific banker and you stay with them until you exit or you head off to IPO. So our group is industry agnostic. We cover CPG all the way to tech, to SaaS, to clean tech, to blue tech, to space.
Ooh,
space.
Awesome.
And applied tech. So happy to be here. Thank you all for spending your evening with us and look forward to the conversation.
It's gonna be a good one. Over to you.
Hey everybody, I'm Chris Rosine of Holland & Knight. I'm a venture attorney. I've been a venture attorney for 8 years now in the LA area. And a couple things about Holland & Knight is that we are a mega law firm. We have offices all over the world, and we can help our clients with basically anything under the sun. So we engage startup clients at the idea stage, help form them, and then can take them all the way through an IPO or an M&A transaction. And thank you so much for coming out tonight, and look forward to talking with you.
Yeah, awesome. And H&K helped us with, and continues to help us with a ton of our deals. So what I love about this conversation is when you think about, pre-raise, pre-raise readiness is such an important topic, because when you go out to raise, you really don't want to start, stop, right? You really want to get it right when you get up. When you're starting your fundraise, you want to get it right? But what does pre-raise readiness even mean, right? So when we were talking about this, Michael, that raise ready, what does pre-raise readiness mean? And I'd love to hear this from the three of you. Who wants to take it first, right? What does pre-raise readiness mean across each of your verticals? And we'll do a quick one here, because then we'll go deeper afterwards.
Yeah, I can take this one. So it depends on the stage that you're at. So if you are just looking to raise your first funds via a SAFE or a convertible note, then your pre-raise readiness playbook looks a lot different.
Yeah.
It's, do we have an entity formed? Do we have our confidentiality and invention assignment agreements in place, which bind our service providers to confidentiality in favor of the company, and take anything that they create and assign it up to the company?
Yeah.
So we're thinking about, is our IP protected before money comes in the door? We're also thinking about our equity. So what does our founder split look like? What do our vesting schedules look like? So what we want to avoid for an early stage company is to have fully vested equity. The reason for this is for founder departures. So if someone leaves the company and takes their equity with them, then we have a big problem, because now we have a bunch of dead equity on the cap table belonging to somebody who doesn't work for the company anymore and doesn't have an interest in the company.
Yeah.
And now we have to go buy it from them.
Yeah.
So that's kind of what we think about in our earliest stages. In our later stages, we're thinking about, let's try and get our company to be as clean as possible so we can focus on the deal and close it. So that takes the perspective of let's make sure we have our legal boxes checked, like our board consents and things like that. And the high level advice there is to engage an advisor who has done this before earlier, like legal counsel or another investor advisor that you have that's helping you with this.
Can I pause you? You say engage that person pre-seed, because the assumption is this conversation is pre-raise, pre-seed, pre-raise, right? So it's your suggestion is at the pre-seed, pre-raise, you should still engage counsel. Is that kind of what you're suggesting?
That's exactly right.
Okay.
And that not from a self-interested perspective. You can engage us, you can engage anybody else that you want. It's going to cost you less money if you do it up front.
So what's interesting is we've had a lot of instances where founders who didn't quite get the pre-seed, pre-raise part right, they have what you describe as dead equity, which means they're coming out and saying, hey, I want to raise, but I've got 30% that's just sitting here that I actually can't raise against, or you can't own this because my co-founder who's since left and done this other thing is still holding that ownership. So super, super important. Okay, let's go. What are your thoughts, Mark?
Ours is way more tactical. Do you have your formation documents? Are you a Delaware C-Corp? Do you have your EIN letter?
Uh-huh.
Who's going to sign on the account? Have you researched who you want to bank with? Because eventually you're going to need a place to put your money, because you're either selling your product or you're intending to raise.
Yeah. And for you, Michael, can I add to the question for you? Because I think this is great.
Yeah, for sure.
What's the biggest move fast, break later mistake that you see creates friction during a raise?
Okay.
Such a good question.
So when I think about readiness, it's less about readiness and it's more about timing.
Yeah.
Because I think the question is always when to raise. A common mistake that I see is founders thinking about raising too soon. I think now, with the tools that we have at our disposal, and the ability to build really scrappy teams and get product off the ground without engineering teams, the onus is really on the founder to find early signs of potential product market fit, more so than ever before. So
Yeah.
I don't think anybody should ever be raising in service of finding product market fit. Oh, I want to raise because I want to build out a sales team because I really want to push product out into the world. No, I think honestly, scrappy, low fidelity product that's breaking but has users and retention metrics is way more compelling than anything else right now. And to be able to fundraise and point at that to an investor and be like, hey, I was able to do this all bootstrapped, it's a testament to grit. So I think requisite to thinking about raising is the importance of having compelling traction, and then the thing that tends to break the most, and I don't think people could understand the nature of this kind of relationship until they find themselves in it, the co-founder relationship.
Yes.
I'm married, it is light years more serious and more inescapable than a marriage. I'm happily married. But it's a very high consequence relationship.
Yeah.
Early stage, people are very quick to create relationships with others because they feel like they need it. I see this a lot with non-technical founders. They'll meet someone who's technical and it's like, be my CTO. It's like, you got to date before you marry. So a couple of things, I think it's just really important to understand who you're getting into bed with. What are the values? Align on values and be different in every other way possible in terms of networks represented, knowledge, problem solving, processes. So I find that most people kind of set themselves up for imminent failure if they don't get that co-founder relationship right out the gate.
Couldn't agree more. And the thing about it, when you do get that decision wrong, you just pay for it over and over and over again. So let's talk about locking the foundations, right? So if you think pre-raise, we've talked a little bit about locking the foundation, right? And I really like this question, right? What are the minimum non-negotiables that must be true early so a company stays fundable? We'll do like lightning round, but we'd love to hear for each of you. Whoever wants to take it. Right? What are the minimum non-negotiables that must be true?
MVP in place, know what it is, and be able to speak to it clearly and succinctly in a short amount of time. Your pitch deck, hopefully you've had it reviewed by your advisor, your co-founder, whoever. Just have people look at your pitch deck so that when you do go to the VC and you've practiced your MVP and you guys are on the same spot with your pitches, you're ready to go.
Yeah, you know why, Mark? This is a game of storytelling, right? But truly, even if what you're building is incredible, if you cannot convey the brilliance in your head to people outside, they just won't get it, right? True. Yeah, jump in.
Yeah, and to jump on that, that carries through on the legal side. Even though legal doesn't come off as a storytelling type of business, it does tell a story if your documents are really messy, or if they're very professional,
Yeah.
or if you missed something that's really obvious and now we have to pay the lawyers a couple $1,000s to fix it. It's a story about how organized you are and how thoughtful you are about the details, which I think carries over to the product side as well. It's a process of executing the fundamentals really well, which can be indicative of your thought process behind a business.
Yeah, do you have thoughts?
Yeah, it's an echo of what I said before, but traction's super important. I'm very bullish on teams that are led by co-founders. I don't have anything against like a solar founder, but I do think it's an important journey to share. But those would be my two biggest ones.
Yeah, I love that. Let's talk about nailing the market, right? ICP, user touch points, Scrappy building, which you've already alluded to. So we'll start with you, right? What is Scrappy but credible? You alluded to this, right, Michael? Like, what is Scrappy but credible proof pre-raise? And what's overbuilding? Because you are constantly thinking about capital, you are capital constrained, you need to build but not overbuild.
Yeah, so I come from the product world, and when I think about Scrappy, it can be product that you're kind of embarrassed to have out into the world, but people keep using it. Like when I come from the B2B SaaS world, right? So I end up having, as an early stage founder, you can have close relationships with your clients because there's fewer, but they're bigger accounts. And so we would put product out into the world that would break, that would be buggy, nothing irresponsible, but for me, a validation point would be, oh wow, people are still using this. There's like a stickiness to it. So it's almost like low fidelity plus retention starts to be this interesting kind of proof point. I wouldn't focus on kind of commodity features. A lot of founders get lost and spend way too much time on like dumb stuff like password reset things. You know, just do a lot of Wizard of Oz, like do as much as you can kind of manually until things start to break. Don't overbuild. Don't be afraid to have scrappy processes. Don't build for a future problem. Only be solving problems that are coming up. And basically I see two kinds of teams. The teams where road mapping is like this like intellectual exercise where it's like trying to look into the future and think about ideas and features, and it's fun. I've been there and I've made mistakes there too. You know, it's a creative space to be in. The best kind of road mapping is we have all these problems from real users. What do we have to fix? It's like being on a ship that's constantly sinking and you're just like patching the holes. That's where you should be, honestly. Because it means you haven't overbuilt the team and you're not over-investing.
Yeah, no, I love that. Mark, did you want to jump in before we go to the next thought?
I would just say, I love the don't overbuild thing, keep it simple. Watch your budget, because I agree with you. I think that you can probably build more than you think you can without money, so be conscious of that. And yeah, I think that's my 2
Well, and a
points.
super clear takeaway is build for now, not for the future problem. Because you're constantly told, and you're like, wait, but there might be this future problem, and you have to make sure that today it's fixed. It's like, no, you're saying like, focus on now, focus on the problems now, because that's what sort of assists with stickiness. But you know, getting distracted, which is so easy to do in that intellectual exercise of like product market fit, it'll literally, or I'm sorry, the intellectual exercise of road mapping.
Mm-hmm.
You just lose so much time.
Yeah.
And time is of the essence when you are at early stage, because everyone wants, VCs in particular, when did you start, right? So time is also something you want to constantly be thinking about. All right, let's jump. So now, let's talk about traction, right? You've alluded to it, you've all alluded to it. What are the traction signals that actually matter, right? So pre-seed versus seed, what traction actually matters and what's noise? I am very interested to hear your thoughts on this. Whoever wants to take it. Mark, you're smiling, you're laughing, like, tell us what you're thinking.
Can you sell your product, right? Like, are you getting customers in the door? Are you getting repeat customers?
Well, Mark, go deeper, right? So like getting customers in the door, how many, tell us more.
Are you getting to a point where you're seeing maybe your costs are coming down because you're getting customers in the door? Are you getting to a point where you're getting profit in and you might be starting to self-sustain a little bit? And maybe you're still thinking about a raise because you've got that roadmap, but you're starting to get some traction and you're building momentum because people are interested in what you're doing, and could mean that you've hit the right target audience.
Okay, I love that. So Michael, I get this question a lot from founders. I've got product market fit, but then VCs or angels say it's not enough, right? I've got product market fit, but I've got 500 users instead of 10,000. Or I've got 10,000 users instead of 100,000. I've got 100,000 users instead of 1 million. So like, what does traction mean when you're working with founders, Michael? How do you help them understand this is a type of traction that you can take out to an investor?
Yeah, I'd be curious to get your pushback on this.
Yeah.
Because I am very bullish about retention metrics over growth metrics. So I'd rather as a founder, like trying to put something out in front of investors, I'd rather have a product where I could say, we have 100 users spending 30 hours a month on this app, right? And very little churn, right? Because it means that you've started to discover who your super user is, your ICP. And if you get that with 100 people, that's magic. Because then it becomes a go-to-market challenge. Then it becomes, okay, how do we move beyond this ICP, or how do we find this ICP beyond LA, if you're very LA focused? Yeah. So I think sometimes growth metrics can be vanity metrics, because like you could cook the books, and you get a lot of people you probably see this a lot, the wait list, it's proof of something, but so I'd say retention metrics are important, and then also I want to be able to see that people are making some kind of sacrifice to get closer or to get into the product. So what's that mean? Let's just take the email list example. And let's say that that's going to kind of be your temperature test, your barometer. Don't just ask for a name and email. Put up a 20-question survey that's going to take someone 5 minutes. And if they complete that survey because they feel like it's going to get them closer to your product or the problem you're trying to solve, that's a sacrifice they've made.
Yeah.
So that would be like in a consumer-facing product. If you think about it in enterprise SaaS, enterprise SaaS has a cost of the actual software, but then there's a huge change cost. It's tremendously expensive to implement any new software in a company. So even if you're selling software for dirt cheap to an enterprise client, but they're putting team behind implementing your tools, that's compelling. So it's the sacrifice the user is making to get closer to your product, and then also retention metrics. But I'm curious to hear what you.
Yeah, I'm looking at time. I'm like, I've got thoughts. What I will share is like AI accelerated the truth of what you're saying, right? So now there are so many AI startups that can talk about the sort of the growth curve and how much engagement they have. But what we've also seen is just as quickly as they've had that engagement, then there's this sort of jump off to the next thing, right? So growth. Yes, they're vanity metrics, I would agree with you, but what I'd say is even more so the case now, because you see, we have seen it again and again and again of a startup that has incredible growth, and then it just kind of like tapers off because there's so much happening in the space that you cannot rely on growth metrics. So our firm really pays far more attention to retention and retention over time, right? So, often I say over the past 3 months we've retained the retention of 88% or 92%. That's great. Let's pay attention to that more, over a longer period. I'd say that's something that we think a lot about. But I think for everyone in the room, what you said and what both of you said that I think is a really, really clear takeaway is talking about growth is no longer as impressive as it once was. How are your users engaging? How long are they staying? Like really go deep, because it also suggests, to your point about the ICP, Michael, that you really understand your user. You really understand them, right? And that's what I think is a really awesome takeaway. I just feel like there should be music in the background. Build. Okay, so this is it. This is why we all came. Honestly, we're talking. It's money discipline is the thing. Team, hiring, advisors without creating a mess. This is it. Because when you're pre-seed, you've got to build a team. If you have a co-founder, great. If you don't, you likely need one because you can't build a thing by yourself. Even with AI, you can't, it accelerates a ton. But you really need to, how you manage the capital early on is everything. So, yes, this is it. And this is what you focus on, Michael. How should founders decide full-time versus fractional versus contractors and avoid legal cap table messes? That like angels maybe will deal with the cap table mess. VCs run for the hills. Like cap table messes are such a challenge. So tell us your thoughts, right? How should founders decide full-time versus fractional versus contractors, and how do they avoid the cap table mess while moving fast? Here, we'll take your $5,000 check. We'll take your $10,000 check. We'll take, would love to hear your thoughts.
I could talk to the cap table piece. So this is a really important part of your company, maybe the most important part. And that is who owns it. And the best way to get a clean cap table is to document your promises in writing, act on them quickly, meaning get the equity issued quickly and don't have these promises outstanding for years. And the third one is to keep an up-to-date cap table that reflects what your company is going to look like pre-financing and then model it post-financing so you understand the dilution of new money coming in. That's one piece of this. The second piece of this is the advisor piece. And the things that I think about in terms of engaging, do I engage an advisor? Do I engage an employee? The rules are somewhat muddy on this in startups, but the two things that you need to remember is that in either relationship, you need a confidentiality provision in favor of the company and an invention assignment provision. That is the most important thing that you need in those agreements.
Well, I'm going to pause you. Just repeat that. I need to make sure.
Yeah, so you need two things in your agreements, and make sure these are in all of your engagement agreements. One is a confidentiality provision, and that ensures that anything confidential that you tell a service provider stays confidential.
Yeah.
That's really, really important. Otherwise, they could just take your confidential info and just go elsewhere with it, including to a competitor. That's one piece. Two is your invention assignment. So basically this means that anything that the service provider creates goes back to the company and is owned by the company. Otherwise, the company doesn't really have an ownership stake in whatever your service provider created for you. So they create your code base. If they're not assigning it up to the company, they own the code base.
Yeah.
So those are the most important things that you need to keep in mind here. And there's other things to think about, but honestly, if you have those two covered, you'll stop 99.
That's right, you're
percent of
miles
major
ahead
issues.
of most pre-seed founders. That's awesome, awesome advice. I don't know, do people take notes anymore? That was like, that's gold. You just got like legal gold. Okay, so over to you, Mark, right? So how should founders decide full-time versus fractional versus contractors and avoid, well, he hit on the cap table mess, but would love to hear your thoughts.
Yeah, well, first of all, we have a free cap table solution. We're gonna save you money, so you can keep track of all that. But as you guys know, you're the founder, and most founders are the eyes and ears of the business, pre-seed, sometimes up to seed round. And then maybe you start thinking about fractional positions in the company, but you are it. You and the co-founder, if you've got a co-founder, you're it. You are the ones combing over agreements, sitting down with attorneys, looking at terms for your banking, looking at terms for contracts that might be required for your platform. You're it. So a lot of times you're not bringing in fractional people until you hit that seed round. And then once you get to a Series A, you absolutely need to hire a CFO at that point, because you need great financials. You need a balance sheet, an income statement, and they need to be solid as you continue to grow.
Yeah. So, Michael, I want to double down on this with you because you and I talked about this, and I think it's incredibly important. As a startup founder, capital's limited. You need someone with a particular set of expertise. You really need them. They're not fractional. They need to be hired full-time. Like, how do you navigate this? And this is really what you've built. You've built a thing to solve this, which is why I want to talk to you about it. Like, how, as a founder, do you figure out who's fractional, who's full-time, and when you really need someone who's really good to do fractional services, how do you know who's good? Because then they'll do, there's that sort of, anyway, this is your area of expertise. I would love to hear your thoughts on this.
Yeah, so I'm a big believer in the elastic team and on-demand talent. Because I've been
On-demand talent, I love that.
I've made these mistakes before of getting way too romantic about team building. Because as an early stage founder, it's incredibly lonely and you have all sorts of problems. And I think a big mistake you can make is putting people around problems and then committing yourself to a very rigorous, unbending team. So for example, let's say you're struggling to find product market fit. Oh, I need a salesperson, right? No, not necessarily. Like early stage, like you guys said, a lot of the stuff is founder led, right? You have to be a Swiss Army knife. You have to do enough of everything to get stuff off the ground. So don't bring in people to solve problems, bring in people to accelerate. And then also keep in mind that your thesis of the ideal team that you need right now, tomorrow and next week, you might have a really good understanding of what you need. And that actually might be the perfect thesis. But 6 months from now, it's not going to be the composition of team that you need.
Mm-hmm.
So what happens is, the worst thing that could happen, and I've done this before, you commit to a very rigorous team in terms of it's unchanging, it's all full time, and then you start to make product decisions around the composition of your talent, right? Because you have full-time employees and you have a responsibility to them. And so it's weird because you become more interested in keeping the machine running than growing the company. So all that's to say, very bullish on fractional talent. So within Build Momentum, I launched something called Founders and Fractionals. And so and it's through application, but we've brought together this incredible cohort of super senior operators, mostly exited builder specialists. So experts in finance, think CFOs, CHROs, CMOs, CTOs, engineers, basically across all problem areas. And then what we do is we match that super senior fractional talent with founders. Because as an early stage founders, I'll give the flip side of what Mark said. Series A, you need a CFO. Seed stage, you should not have a CFO. But a lot of founders don't know about how money moves in the company. So they're I need a money person, I need a CFO. No seed company unless they're, I don't know, is there a seed company that needs a CFO?
No.
No, okay.
How even fintechs
But you need access to one. You need one on your side, and you need one where there's continuity in the engagement with them. So we do a lot of that work.
So can I push back a little bit, Michael? Because I hear you. I agree that a pre-seed, seed stage, you don't need a CFO. What I hear from a lot of founders is the challenge with fractional talent is they're fractional and they're interested in what you're building because they're working with a bunch of other startups, right? And And so they're like, well, I don't really want to work with a fractional CFO because they don't give me enough time, and they're like doing all these different things. So like push back, but like tell us why even still you're still bullish.
I don't know. I think it'd be unrealistic to want to work with Chris and be like, Chris, let's be exclusive. You know what I mean? Like, it's just an unrealistic expectation,
Yeah.
I think, to be honest.
Yeah, no, I love that. I think for founders, I think it's helpful to hear that. Like,
Yeah.
it's not a realistic
Yeah.
expectation at the stage of your business. Like, are you ready to pay for
Yeah,
a person to be full time?
But also the onus is on you. As a startup founder, you're evangelizing. You're constantly selling. You're selling to investors,
Yeah.
you're selling to your clients, and you're selling to talent. You have to be able to evangelize talent. The great thing about fractional, and I've seen this with fractional placements we've made, is it's date before you marry.
Yeah.
So it de-risks it for both the founder and the talent. So I'll put a CMO fractional into a company. It de-risks it for the CMO, the marketing expert, because they get a feel for the founder, they see how they react to pressure and solve problems, and it de-risks it for the founder because they get to have this flexible working relationship that maybe over the course of 3-4 months transitions
Right.
into a full-time engagement, and maybe there's an equity play. So just a way of structuring a little more try before you buy into the talent relationship.
I think that's such a great way to frame it, right? It's not that this person's come, it's not like a SWAT operation, right? They're coming in to help with the thing and coming out. It's like there's an opportunity to have this. You can still have a long-term fractional relationship. I don't think a lot of founders.
The continuity is more important than the exclusivity.
Exactly.
Yeah.
And I think that you can still have that continuity, even if you don't necessarily have the exclusivity. Mm-hmm. Yeah, I think that's a huge point to take away. Do we get to do Q&A? Okay, almost. So this is founder reality, emotional readiness, and risk mitigation. One of my favorite studies is the MIT study that talks about one of the main reasons that founders the reason their company shut down is because of burnout, right? And so this topic around emotional readiness and risk mitigation sounds like it's fluffy. It's not, right? It is not. It's super serious. Interested in your thoughts. I'll start with you, Michael. What does emotional readiness look like in practice?
I think a lot of it has to do with understanding your risk tolerance and your comfort with risk. I feel like there's this mantra, which is like, they're not going to invest in you unless you're all in, right? When you're all in and it's like pre-funding and pre-revenue, you're in an incredibly vulnerable headspace, right? Like I'm a really big believer in figuring out ways to de-risk it for yourself, to have a bit of kind of emotional financial safety. What might that look like in practice? I work with a lot of founders that are in big corporate jobs and they're just starting to build their companies, and they're not going to leave and burn the bridges until they have those proof points, that traction that gives them the conviction to go beyond the golden handcuffs. The other thing that I recommend to a lot of founders is side hustles and consulting. So if you have deep builder expertise and you can monetize yourself beyond the startup that you're building, that's amazing because that puts you in a much safer headspace. So understand your risk, understand that once folks have invested in your company and you have institutional investors on board, the relationship changes. You become a fiduciary to your investors.
That's right.
You're responsible to people beyond yourself. That's a before and after moment. It's one thing for me to leave my day job and maybe I'm beholden to my partner or my family and they're sharing in on the risk. It's another thing to bring investors into your cap table. Just understand the consequences of bringing on capital. And talk to maybe other founders who have had those before and after moments. See how it's changed their day-to-day. See how they maintain their own well-being.
Well, can I follow up on that? Because a lot of founders hear that consulting and moonlighting hurts focus. You're saying it could potentially help. So let's talk about when does consulting and moonlighting help runway versus hurt focus? And how do you set boundaries clearly? I think, because I do think at that early stage, you've got to do it. Like, I really do think you need to consult or figure out side hustles. But then let's talk about the reality, which then sometimes there's some tension, right? How do you
There's a lot of tension.
Yeah, let's talk about that.
Because people and problems are competing for your time and attention.
Yeah.
If the consulting work can somehow be a driver of growth for the company, that's awesome. If you could do, I'll just make up an example. Let's say you're selling some B2B SaaS product, right? And you have this kind of plug-and-play solution, but you're really close with the industry players. You're in with the C-suite, and they're looking for problem solving that's more bespoke or beyond your product. Maybe figure out a way to charge for it, right?
Yeah.
It's not scalable, it's consulting. The problem with consulting is you're selling your time. There's no leverage. But if it can protect the cap table and mean that you can raise a little bit later or get more traction, to defend a higher valuation, that's awesome. But it's very, very tricky because at the end of the day, you want to maintain your own health and well-being. You want to maintain outside interest, and then you're starting a company, and then you're consulting. It can be a lot, but once you start to see those proof points, it usually becomes really clear when it's time to leave the hustle, right?
Yeah, and let's talk about the legal ramifications, right? Like of moonlighting while you're building the thing, and then you have a cap table. Talk to us about that from the legal perspective.
Yeah, so a couple things to think about in terms of moonlighting is that you want to, if you're doing 2 jobs, this seems like a very basic thing, but you want 2 laptops, one for job 1 and one for job 2. The reason is because you don't want to use your work computer for your startup, because then, anything on that can be assigned back to your employer. So that's one thing to think about from just like a practical perspective. 2 is that, you need to think about dilution in terms of your service providers. So anytime you issue equity from your stock plan or to a consultant or to an advisor, you're diluting the cap table, or you're running out the clock on your stock plan by just taking shares out of it and issuing it to somebody. So those are kind of the 2 things that I think about in terms of moonlighting.
Yeah.
But the most important one is to just, IP protection is probably the most important thing that you can do, and just keep your world separate in terms of moonlighting.
Mark, will JP Morgan bank founders who are moonlighting?
Of course.
Of course.
Of course. You might not want to quit your day job while you're doing the research, while you're figuring out if your idea is going to work.
Yeah.
You might want to keep your day job until you get to those proof points that Michael spoke of. And of course, you can have 5 jobs, you can have 10 jobs. It doesn't matter to us. But too much, then mentally it's probably not good. But yeah, absolutely, you might consider keeping your day job until you get the research part out of the way, until you get to a point where you feel like you can take those proof points and go out to the public and see if your product's going to work.
Okay, so I love that. So as we wrap up, I do want to come back to this question because I don't feel like we fully hit it, and it's such a big deal as a founder when you think about emotional readiness. You can call it whatever you want to call it, but I think the mental health of a founder is something we just don't talk enough about, and it is a multi-year game, right? I mean, you talk about like when you're with your co-founder, you're married to them for at least a decade, right? Really, like even and so I want to come back to emotional readiness and let this be kind of how we wrap it up and open up for questions. But how does emotional readiness affect execution and fundraising? And like, if there's a takeaway for the room as the pre-seed, right? So you're a pre-seed founder. That means you've got at least 5 years, right? I mean, it's just that you are just kicking off for a multi-year thing. What does emotional readiness look like in terms of how does it affect fundraising? How does it affect execution? And what key nuggets can we leave the room with?
This is really personal, so take it or leave it. And it might sound a little bit cliche, but I really believe in clear boundaries. Like, I'm people before product, and like, your product can only be as well as you are. So I have really clear boundaries. Like, I've been a mercenary before. I've thought about building as a sprint. Again, this is cliche. It's a marathon. You have to pace yourself and find joys in the things outside of work. So for me, for example, exercise has been really important, not as a break from work, but as a different creative space. So I swim and I run every day without fail. It's just a part of my calendar that doesn't exist for anybody else in the world. It's totally blocked out. It's uncompromising. I mean, with exceptions, obviously. But it also becomes this incredible headspace where, I bring to the pool 3 problems that I'm working on, and I solve them over the course of an hour, and I get some exercise in. So
I love that. So
that's been really important for me. Like, I learned the consequences of just going hard. Life's really short. You got to take care of your vessel. But that's deeply personal. Because on the flip side, you could push back against it and be like, time is of the essence. Go faster, go faster, go faster.
But if you're dead, it doesn't help. Right? So we need you to anyway. No, love that. That's incredible. You have to take care of your actual health so that you don't burn out, per the MIT study. Love that. Mark, what would you leave us with?
I think the same thing. I go for a walk every morning to set my day straight. I do the same thing. I think about my schedule. I think about what I need to accomplish. I'm in the corporate world, so I gotta call 10 of you, send 500 emails, respond to another 100. So it just really helps you balance your day, at least for myself. And again, it's personal, but it really helps me set my head straight for the day. And I feel like I'm clear when I then get ready for work and I'm in the car for another hour. I think that's a very valid point. And then I also hear from founders it's very solitary.
Yeah.
So take the time to socialize.
Yeah.
Whether it's an event like this or go out with your friends, go out with your family, so that you're taking care of your mental self.
Yeah. What would you leave us with?
Yeah, so these strategies to help manage stress carry through to your legal agreements. Because if you stay with me here. Because if you are regulated and have your whole life together, it's much easier to zoom out and see the bigger picture and not get tied up on little things which can create problems with your investors. So it can be very good for legal management strategy for you to go on a walk and regulate yourself. It makes your life a lot easier, it makes your investors happier, and it makes your legal team very happy.
Have you given that advice to a client directly?
I have not, no.
Regulate yourself?
Go for a walk. You need to regulate yourself.
This is non-client advice.
No, I love that. I'd probably leave. So I recently hosted an investor meeting where we had about 50 of our investors fly in. We talked about how our firm is doing. And we invited a woman who has summited the 7 second summits. So in all of them, she holds the Guinness World Record for this. And when she talked about that, this was last week, so it's super, super fresh for me. But the one takeaway that she shared was similar to what you said, Mark. So like your team is everything, because this is such a solitary experience for her, but it very much aligns for all of us as founders, right? Whether you're founding a VC firm or building a company, who's your team? And not necessarily like the team that you've employed, but like your personal, whether it's your family, whether it's your community. We talked about continuity of community or team. So meaning like, it's great to come here once, but my goodness, if you came like 10 times, because then you really get to know people and they really get to know what you're building. And so you do more than just like a, hey, nice to meet you, we'll connect on LinkedIn, but hey, actually let's go chat about what you're building. And like, maybe I know a person, maybe actually I need to introduce you to someone. We should just chat, because that would make all the difference. So I think that community, but continuity of community, in her case, when she was talking about like the team that helped her, she didn't have that team or that community and her family to come back to remind her like, you're insanely amazing for doing this, then would it be worth it? And so I think that emotional readiness piece is so important. Okay, let's open up for questions. Yeah? Okay, let's do it. Amazing. Yes. How are we doing this? How are we doing? If you just stand up and if you stand up, introduce yourself, I think, or do we have a mic?
Yeah.
Just project, name, and love to hear your question.
Danny is my name. I'm a non-technical founder.
Okay.
And I was trying to get an MVP together last year, and I had a very difficult time with, I did the, what was that term you used?
Vibe coding.
On-demand talent.
Oh.
And I had trouble because that was like a product manager type person, technical product manager type person, and I found that in that world of tech, there's so many software, so many types of coding, non-coding, low code, full code, and each person knew only their domain, so I had a tough time managing them because they were also not sort of like fully aware of all the possible solutions. So curious what you would say to a non-technical founder when they're trying to find, on-demand
Like
help.
fractional. Okay,
Yeah.
love that. What are your thoughts, Michael?
I think it's important to have a technical expert on your side, because I've seen this a lot with non-technical founders. They have a technical problem and they're like, I need a CTO, and they can't even define the technical talent that they need.
Yeah.
So again, that's a part of founders in fractional. Like we work, so for example, when I work with a founder like you, I bring in my lead engineer and we sit with you and we understand your technology, your problem, where you're at in your build, and then we can make a recommendation of what you actually need. Things that I would avoid, and I'd be curious to hear your thoughts, I'd avoid dev shops early on. You don't want to send somebody a recipe for a product because that's not how things work. Like, what you think you need actually isn't what you need. So I would avoid dev shops. But like, we lived in the golden age of no code tools. So vibe code as much as you
Vibe
can.
code,
Just you
totally.
learn the tools. If you're
Yeah.
not technical, but you have some product sense and you understand the problem, you can get it 90% of the way there.
Yeah, couldn't agree more, right? The tools that we have at our fingertips today mean that you have the opportunity to try to get as much of a handle on it as you can, such that you can have the fluency to talk about and have an understanding of what you need, right? I think that would be very, very hard if we're talking about this years ago. I think today you actually have the opportunity to develop your own understanding by vibe coding, and like I think it's just such a new moment for founders in that respect. So love that. Yeah.
Have you invested in a team without technical talent yet?
We haven't yet.
Do you think you
And
will in the next 5 years?
We're in the next, for sure. I think in the next 5 years, for sure. I think this is like the pace of change is, I would say, it's like we're following it, but we're not quite there yet. But I think we're I would say like a year, because we're actively deploying. I meant to share that with you. We are actively deploying, we're actively deploying, looking to write checks on about 10 to 12 new founders. Any other thoughts to his question? And do we have any other questions? Oh, wow, look at all the hands. This is great. You go. And like, quick questions just so we can tackle them. Would love that. Yeah, please.
Right.
Yeah, please.
My name is Juan. I'm building personalized fragrances, and we have a bit of traction, but I'm wondering how to structure it legally. So like, a lot of people say C-Corp in Delaware, other people say LLC. Like, this is more of a practical question for Mark. Like, what do you like to see? And also for a lawyer here, yeah, what would you guys like to see in terms of a founder that's putting it up there?
Yeah, I think the ultimate question is, who do you want to raise money from? If the goal is to end up with VC funding, then the Delaware C-Corp is the answer in 99.99% of the cases.
999.
Maybe 100. But if you're just looking to cheaply get started, you want to raise money from family and friends, or maybe not even raise money, you just want the liability protection, an LLC is very easy to start, and it's easy to convert to a corporation when you're ready to make the next step for VC funding. Typically, for someone in your stage, if the ultimate goal is to get VC funding, is to start with a Delaware C-Corp, and then you don't have to pay legal fees to convert your entity.
The follow-up question would be, in terms of the equity, like, do I just put 100% to me? Do I put like 15% to like investors in the future? Like, how would you structure that initially?
Yeah, so you could do a couple different setups. There's two concepts that you need to think through with shares. Is authorized shares. That's the maximum number of shares that you can issue, and that number is listed in your certificate of incorporation that you file in Delaware, which is your charter of your company. Yeah. And then, so you can authorize 10 million shares and issue yourself 1 million, and then you hold 100% of the company, and then you have 9 million left to issue. So you can kind of do whatever you want. You can issue yourself 10 million shares and have 0 remaining. So, it's up to you, and there's different approaches to it. But most companies typically authorize 10 million and issue about 8. So they have a little buffer left over.
Will you be around afterwards?
I will.
Great, because that's a great question. I'm sure others will have more for you. Love that. Great question. Yeah, please. Go ahead. I just can't see your name, but yeah.
My name is Alex. I'm one of the co-founders of Midpoint AI. So I have 2 questions. My first question is, we've been out for 2 weeks. We have a lot in pipeline, but we just closed 48K ARR in the first 2 weeks we've been out. My first question is, when do you think a good time to raise is, and what do you think the proper amount of ARR, or the way you look at it in terms of raising would be? Like, when is a good time to raise?
I think you should answer that, but I have a follow-up question.
Okay.
Why do you think you have to raise?
That's my question, right? So like, why raise? I think one of the assumptions that we have as founders that we should raise. Yeah, I'd love to hear why.
So, me and my co-founder go in between the idea of raising, and we're not currently trying to raise, but the real question is, we need speed, we need scalability. We've proved to some degree that there's product market fit.
Okay.
But the real question is, in a space that's getting increasingly saturated, I think, I know this is build fast without breaking things, and I think if you put everything down to a team of 3 to 5 people and get incredibly scrappy, and you're dealing with tons and tons of deployment issues. You're going to need a forward deployed engineer for my business.
Yeah.
You might need multiple.
Yeah.
2 people can only do so much.
Yeah.
You know what I mean? So
Yeah.
the real question is, at a point where the amount of contracts we have in enterprise or the amount of consumers on the consumer arm we're dealing with become so volume heavy, we're going to need help with infrastructure, we're going to have runway problems,
Yeah.
we're going to have all of these issues. So I guess
So here's my key takeaway for you. I would focus on the VCs that are investing in what you're doing, because if you do that, or so you do not want to go to general VC, you do not want to go to generalists, you want to go to VCs that specialize, or folk like AI VCs. There are tons. They're here in LA. You can find me afterwards. I can give you very specific recommendations, because the argument that you're making, which is you're noticing your space is getting quite saturated, and so you've got to like pick up, move fast. Otherwise, there's like you could get pushed to the side. That is something that a lot of my peers talk a lot about when it comes to the AI investing, right? So with that in mind, I would say you've already answered your question in terms of does it make sense to raise. You're basically saying I'm looking at the market that I'm playing in, and by looking at this market, there are too many folks coming into the space. Either I'm going to take off and grab enough market share, right, and do this sort of lag grab, or it's not clear that I'll be the main player in the space, right? And so if that's what you're saying, without me going into a ton of detail, and like you can find me afterwards, but then you're making a case that, hey, it probably makes sense for me to fundraise. If you're doing 50K in MRR, I think that's enough of an ARR to get a pre-seed. That's better than what a lot of pre-seed companies are doing. So that is certainly enough to go in the market and fundraise. And so the answer is, you could fundraise now, but to be efficient, because the thing that we didn't talk about is fundraising pulls you so far away from the work of building the business. And so you have to be hyper efficient if what you're saying is, hey, this market is moving very, very quickly. I'm seeing a lot of activity. We need to get some capital so that we can accelerate. You also want to make sure that you're able to then focus on the business. What would you add to that?
Well, yeah, as a founder, it's another full-time job that you're adding.
Exactly.
It's another hustle. And not only is it the time and bandwidth, but it's a very emotionally grueling hustle, because it's a lot of ups and downs. It's like you have to have undying optimism. You have to be very comfortable with rejection. You can't take it personally. It's you get a lot of rejection. So it's not necessarily a fun thing. At the end of the day, it's coalition building. It's building meaningful relationships that are probably going to last you a lifetime when done right. But don't underestimate the amount of time and effort and energy and the ways in which it's going to pull you away from your core work. Right?
How do you make that clear? Because it's so hard to imagine. Who's fundraised before in the room? Okay, that's like not a lot, but for those of you in the room, you know, right? It pulls you away from the business. It pulls you from really being competitive in the space, right? Okay, so behind you there was someone else. And did you have a follow-up?
I have one follow-up.
Yeah, of course.
So in the fundraising process,
Yeah.
My co-founder and I, he lives in SF, the rest of the team's in SF, I'm here. He was saying maybe one of us just go to VCs independently and go and try to raise. Do you think there's a downside of not having a full founding team while you're fundraising, or no?
No, most VCs expect that it's not going to, they'll want to talk to the co-founder for sure, but it's not, if you're both out fundraising together, right? I mean, am I wrong here?
I think it would generate more doubt. It should be a divide and conquer thing.
Yes, it has to be a divide and conquer thing. In fact, if it's both of you out fundraising, you're like, well, who's focused on the business? So that's totally fine. Divide and conquer. So behind you there was a person. Yeah, please. And name and then your question, please.
Yeah, so my name is Nuin. My question is kind of related to global founders in general, rather than maybe US-based founders, which is, this is called like pre-raised readiness, let's call that point A. What if you're like in the wrong market, let's say? To get to point A, that's a whole journey of its own. It might require maybe small fundraising, smaller tickets, a bit of a messy cap table to get to the right place and put your product. I wanted to hear your perspective on how investors might see that as someone who is a global founder who had to get to this point, and it's a whole journey of its own.
So I want to let the panelists answer that before I jump in. Yeah.
It is just to understand your question. Is it about kind of the pre? Are you talking about the pre? Like how do I get to a novel idea or something that I want to like double down on? Is that
kind of to reach like the same starting point as a lot of founders have, who maybe let's say live in California, for example, or I don't know, like basically there's the whole moving, maybe raising some money to get yourself to the right market. You're in a country where the market is not maybe the right fit for what you're building. There's a whole journey to get to that point, and I'm kind of looking to see how investors might look into that.
Yeah.
Maybe you took like 4 10K small 10K tickets to get yourself there, or had a whole like journey to create
Well,
something.
I think in general, the ability to work across borders is a huge testament to founder grit and agility and reinvention. And so I think there's a lot of storytelling and being very candid and authentic about your story, sacrifices made, personal investments made, comfort with. Think about what it is to move to a new country. It's dealing with one of the most ambiguous, uncertain situations of your life. That's the founder's journey. So I think there's storytelling that can be had in connecting grit, uncertainty, ambiguity that you've been able to face and kind of excel and see yourself through, and then translating that into the founder journey. And then tactically, I think something super important is just what you're doing right here. Just connect with people.
Yeah.
Just meet as many people as you can. Go to events. Talk to unfamiliar faces in the space, because folks will become your soft landing. And if they believe in you, and if they're inspired by your story and the grit that it represents, they're going to want to see you succeed. Yeah.
How many quotables in one conversation that folks will become your soft landing? Like take that, like everyone take that. Like that's amazing.
Yeah, I mean, it's people want to support people that are doing brave things because it makes them less lonely and doing. Nobody wants to do a brave thing on their own, right?
Yeah. Anyone else before I reply? Did you have any thoughts? So what I'm hearing, right, which is the essence of your question, is like we're talking about being here, but there's a whole step that involves getting here, and it can be messy, right? That means, yes, you can say don't take 5K and 2K and 10K checks, but like if that's what you need to get here, then you're gonna take the 2K and the 5K checks. And so then how do investors look at that? And I'll tell you, it's just a tough question because it really does depend on the firm. What I think the more important thing to take away is actually what Michael said, which is grit, right? You did that. If you did that and then also built traction and no one's gonna say like, oh, right? So it's like, I would say take that as a extra like badge that you were able to do that and then come and then build traction and if anything, if there is a VC that's talking to you, they're just going to be more impressed, right? But if you then do all of that and then build traction, I think there isn't a VC that's going to say, oh well, his cap table's messy, but he's done X, Y, and Z that's incredibly impressive, and we're not going to invest, right? I think that's when you'll start to see VCs make exceptions, truly. So do not perceive that as a reason not to go out and fundraise.
Thank you.
Yeah,
Of course.
Flex it.
Yeah, I love that. Please.
Hi, my name is Lainey. I was wondering if you could share your thoughts. What are your thoughts if a trust is on the cap table and the founder is one of the beneficiaries, and how does that affect QSBS?
Did everyone hear that? Okay, you got it. We know who that question is.
This sounds like me.
Really good question.
All right, so a trust on the cap table isn't a concern. We see that all the time. It's more of a tax management thing for the founder, and founders do it all the time for that reason. So that's okay. The second part is QSBS. So QSBS is a tax benefit, essentially. Its full name is Qualified Small Business Stock. When a company issues QSBS, there's certain tax benefits that the holder of the stock gets upon exit. The rules are eye-wateringly boring and incredibly complex. But as far as I know, a trust on the cap table doesn't impact QSBS.
And then if you have more questions, find them afterwards. Are you? Yeah. And someone's gonna tell me like time and like when I should stop taking questions. I imagine.
2 more questions.
2 more? Okay.
Hi guys, my name is Andrew. So I have worked at a couple of e-tech companies, and as you know, e-tech is incredibly capital intensive. But we were talking a little bit about like the storytelling versus like the revenue, and like traditionally a lot of these bigger bets, they don't really have that much revenue. And so where is the line between storytelling and putting a narrative out there and trying to build like that conviction versus like where the wrong numbers are? And does it change as you go from pre-seed to seed to Series A and stuff like that? Thank you.
With storytelling, part of it's like the ingenuity and creativity of the story. And then with the storytelling, essentially you're stringing together proof points. And proof points can be the things that we've spoken about a lot now, like traction and all that kind of stuff. But it can also be founder credentials, like past founder experience. And so I feel like a lot of the plays in deep tech is it can be pre-product or pre-revenue. Sometimes certain kinds of technology really does need venture cap. You just can't hack it together with Lovable, right? Like you can't make a deep tech with Lovable. So that's when you're really going to lean into what have the founders done before, have they created returns for investors in the past, have they exited companies. That's my take.
Yeah, and I think is your question is like for deep tech startups that are capital intensive, when is storytelling?
No, that's too specific. It was trying to highlight that there are companies and ideas
Uh-huh.
that require a ton of capital,
Yeah.
but there might not be any proof in terms of traction
Yeah.
of those things.
Oh,
So
yeah.
you have to have like this dance between the numbers versus the storytelling. I just highlighted deep tech because that's a classic.
Okay, got it. Okay, got it. So the question is, when is storytelling not enough? So at the pre-seed stage, like truly pre-seed, back of a napkin, there's a whole new conversation around how many VCs are writing checks into like true pre-seed. But at the pre-seed stage, truly it is about the story. It is about the narrative. That's almost exclusively what it is about, because there's not gonna be a lot of traction that you're gonna be able to speak to. There's not gonna be a lot of revenue. But again, like not tonight, but there's a huge conversation that I have with my peers and the other investors in the room, like who's writing true pre-seed checks, right? Where it really is all about the narrative, and you just see a lot less of that. If we're being honest, wouldn't you agree?
Well, it depends. Maybe institutionally, but that's where angels really come into play.
Well, right, and angels aren't VCs, right?
Yeah, exactly.
Angels are the answer. Angels are the answer because they will write the early pre-seed.
And it'll be faster.
It'll be way faster, and you'll get the answer. And truly, it's about the narrative. It's about what the vision. How are you going to completely change the world as a function of what you're building? That's what they want to hear. I think, Art, you're our last question.
I'm so sorry. My name is Art.
Hi,
I just
Art.
wanted to drop one quick thing to this. It was like maybe 7 or 6 years ago. It was in a different country, but I raised $500,000 just by writing a piece of paper. So 2 people wired $250,000 each, just by the story. So that's basically kind of the proof.
That
what
is-
you were saying. They were angels, like no traction, no nothing. It was just a description of the idea on a piece of paper, less than that. So I think it's also inspiring to tell people that it's very possible.
100%.
Because you can just sit and wait and think I will never be able to raise anything if I don't have this and this and traction. And that's not easy too. So it is possible.
It's totally possible. If there's anything that we walk away with, then it's that it's possible, right?
Yeah.
Like it's totally possible, and it's possible by like what you said, what we were talking about. It's like making sure you find the right investing partner, which wouldn't be a VC at that pre-seed. It's an angel, right, Michael?
Yeah, and at that pre moment also, it's about not product market fit, it's about founder market fit.
That's right.
Like, are you uniquely equipped to take on the problem that you're committing yourself to? Do you have unfair access to networks?
That's
Do you have IP? Do you have not like actual insights? Like insights are something that it's IP that you could sell to somebody else. Like, so that founder market fit, like surely like that 500K came because they believed you were
You're the
uniquely
guy.
equipped to
That's
solve
right.
that problem in that market.
That's right. We've got a burning question, and then I think we're done. All right, we're ready for your burning question.
Just one question, because at
two
this
burning
stage,
questions.
pre-seed is always the founder fit. But any advice you have for founders that are unfit? Because there's so many great ideas out there that lack execution. Because people are like, "Well, I didn't go to Stanford," or "My dad's not rich." What would be your advice to that founder? Like, I didn't work at Facebook for 5 years. Why should I do this? But the idea is fantastic.
So is your question, did you get the question? I'm
No,
supposed
not
to
entirely.
translate it. It's like this idea that what if you could build a thing and you're an incredible executor, but you don't necessarily, but you're not on paper, you're not the founder market fit.
I'd say I would push back against any assumption of like what's the definition of a founder, because it's if anything, of all the professions out there, it's the least credentialed. Because you don't get a master's in founder. like it's totally uncredentialed. So, you know, the real good investors appreciate grit and ingenuity. They appreciate big, seismic professional pivots, different ways you've taken on risk in your life. And so I would just push it back against what seems to be an assumption that there's some people that don't seem to be founders, right? Because the right investor will recognize a founder in anybody.
Any other thoughts?
Wait, sorry.
You have to help me. There's a lot of continued engagement. We
Maybe
can keep going.
let's do one more question and then
But this lovely guy with the plaid red gnome behind you, he had a question.
Paul Murray, B2B SaaS founder for Life Sciences. Quick question on the fundraise. What are the common mistakes that you've seen founders make that slow down a fundraise, especially when they're trying to get that first term sheet?
Good, amazing question. We're gonna do a founder, what did you call it, like
rapid fire.
rapid fire, okay, your question.
Oh, no, I
Yeah.
just wanted to clarify a question. I think what he meant was like, the founder doesn't have domain expertise.
Okay, got it. So founder doesn't have domain expertise, should they still build in the space?
Oh, okay.
Okay, yeah,
Kelly Shear, my question is around advisors versus consultants or contractors, specifically in health tech, being
Yeah,
able
good one.
to think about building your team
Yeah.
and showcasing
Yeah.
to fundraisers who have a medical advisory board,
Yep.
and then how much equity we should be
Yep.
thinking about giving those advisors as well.
great question. Are we done? Are those the questions? And then we all get to network afterwards? Okay, wait.
Yeah, I wanted to ask about finding a co-founder. I'm a non-technical founder. I have domain expertise.
Okay,
And I've learned a lot about what the technical person needs to be, but how do you go about
Finding
finding
them.
that
Yeah.
co-founder, and how much equity do you give up?
okay, woof. Do we have drinks or food? Are we having dinner to get, okay. All right, so we'll start. I don't know why we did this because I don't remember anyone's question, but your question is. Yeah, so this is like the one mistake to take for everyone. It's just so incredibly important. We've had founders come to us and they haven't worked with counsel and they're raising on wild valuations, right? We had a founder come to raising on a $50 million valuation, wasn't AI. And when we start to ask, questions, and it's like, this is, you should have talked to someone before you go out in the market, because it doesn't mean that founder isn't smart. It doesn't mean that founder isn't building anything that's great, but from the perception of the investors, but it's signaling other things. Have you built a good team around you? Do you have good advisors? Because building and scaling a business, when we talk about the continuity of community, it also, you're not just because you have a great idea doesn't mean this is going to take off. It's really important who you have around you and you're well advised to get to that point. Do you want to jump in on the point from fundraising mistakes you've seen?
Not on that one, but on another one.
Okay.
That I did remember.
Okay, good. Are we jumping to the next one? Do you want to jump in?
Yeah, I have a fundraising
Yeah,
point.
yeah.
So one fundraising thing to think about is the type of equity that you're issuing or the type of security. So there's a couple different options. Safe is the cheapest. Convertible note is also a choice, a little bit more expensive. And then priced round is preferred stock. That's the most expensive. So you want to think about how you want to raise the money too.
Yeah, okay. So then the next question you were going to clarify.
Thanks for the clarification. Okay, so what are the opportunities when you're not a domain expert, but you have that founder bug, you want to build, right? Find somebody that you believe in, be a co-founder. I feel like sometimes the best co-founder partnerships are someone who's a domain expert and someone who's a real visionary thinker or first principles thinker or a hardcore builder, right? So that's an ideal combo, because oftentimes you don't want two co-founders that both have domain expertise, because you want an insider-outsider relationship to the problem that you're trying to solve. If you're all insider, you know the rules of the game, and you're not going to be naive enough to come up with a novel solution necessarily. If you're insider-outsider, the outsider pushes back. The insider goes, this is how things are done. The outsider goes, well, what if we did it this way, right? So that maybe you could find a good partnership with a domain expert.
Wow, such a good answer. And then to your point about advisors, I'd love for everyone to chime in. Did you have a thought, advisors?
Yeah, I could advise on this one. So the two types of general contractors are advisors, which are high-level advisors that deal with business issues that don't necessarily contribute IP. So that's one set of advisors. They get a shorter agreement that covers the main issues that we discussed earlier. The second type of agreement is a consultant, which deals with they basically develop IP is the main distinction. Their agreement's much longer because we care more about making sure that their IP that they create is locked down. So those are kind of the two distinctions. And the amount of equity you should issue to each advisor, it depends on the industry you're in, but a good ballpark figure is given in the FAST agreement, FAST agreement. It's in the back. It's just Google FAST agreement. You'll find it. And it's what stage of company you're at, what they're doing for you, and then how much equity they issue to you. That's a great ballpark figure to make sure that you're kind of within market and you're not going overboard in terms of how much equity you're issuing.
Very good thoughts. So, given I invest in healthcare, I 100% would suggest advisors, particularly medical advisors, over consultants. Because, anyway, we can go into why, but that's a quick answer since we're doing rapid fire. And then,
Yeah, I'm just writing.
Oh, co-founder. How you find a
Yeah.
technical co-founder?
And how much equity do you give away?
Well, that's on a case-by-case basis. How you find, that's a lot of the work that we do. So we partner with non-technical founders and help them understand who their ideal technical co-founder will be. And then we lean into our pool of super vetted engineers that are looking for these ownership opportunities, these opportunities to join a compelling domain expert founder and help them build their vision. So that's something that we could support you on. And then in terms of equity, I mean, it's such a dance, but it's all about understanding what kind of risk each person is taking on, the sequencing of that risk. You know, if you're solo right now, you've done a lot of work to de-risk, right? Also, you know, networks that one founder might give you access to. It's really tricky, but and I think this goes back to one of Chris's first points, it's something that should be non-ambiguous as soon as possible, right? I don't know, is that what you would recommend?
That's right, yeah.
Yeah.
And I just make sure that if you do bring on a co-founder, that you subject their shares to vesting. And a typical vesting schedule is 4 years, and then there's a 1-year cliff. So if they leave after 6 months, they don't get anything. That's a good way to, I mean, you don't really want to test out co-founders, but if it doesn't work out and they leave, then you don't have a bunch of debt equity on your cap table.
I mean, the quality of the content tonight has just been so good, because if you do just that one thing, but you told us a bunch of other things if we just did those one things, so like just that one thing that you shared would be game changing for the future of your business. But I think just the content tonight has been incredible. So with that, can we thank our panelists? Perpetual next question is just a function of how awesome you all have been. So I'll pass it back to you, Michael, to tell us what's next.
Oh, what's next? No other programming. Thank you so much. Thank you for the thoughtful questions. And enjoy the evening. Meet some people that you haven't met before. Come up to any of us, ask us questions. We'd love to meet you all in person.
Yeah. Woo.